Good day, welcome to today's class. If this is your first time on this channel, please click the red subscription button to subscribe to this YouTube channel so that when we drop more videos, you'll get notified. So in today's video, we'll be treating a very interesting part of company income tax, which is computation of minimum tax. Yes, computation of minimum tax. Yes, so this minimum tax law has been revised times that number, but the one I'm treating is the latest one, which is according to the 2021 Finance Act, and it's still the one that is still in use till when this video was made, and this is 2025. It is what we are still going to be using. So what do we mean by minimum tax? Let me give a brief explanation on it. Minimum tax is the list by which once a company's tax cannot go below. Yes, let me put it very well. If, for example, now after computing your minimum tax, we get to realize 36 million naira. So that means that as a company, you cannot pay your tax. If you compute your normal tax, it should never go below 36 million naira. So that's what we mean by minimum tax. That means that your normal tax should not be below your minimum tax. And that is for number one. Number two is that in a situation whereby a company makes loss and they are not, tax is always on the profit of a company. So in the situation whereby the company record loss, they are going to pay their minimum tax. That means that if for a particular year your company did not make profit at all, you are still going to pay tax, but that tax you are going to pay is your minimum tax, not your normal tax. Your normal tax might be around 100 million naira, but your minimum tax might just be around 36 million naira. So this is the major reason why we compute minimum tax. And to watch our time, there are other things you need to know about this minimum tax. And number one thing is that we have three classification of companies. I think I said that in my first video. So we have the small company, rather medium company, and the large company. So small company are excluded from paying minimum tax. Yes, small companies don't pay minimum tax, and other companies that don't pay minimum tax are companies that are into agriculture. Any company that is into agriculture, agricultural produce and all of that, they don't pay minimum tax. And finally, companies that don't pay minimum tax are companies that have not operated for good 4 years. So according to the provisions, is that companies, agricultural companies, small companies, and companies that have not operated for good 4 years will not pay minimum tax. But if you have been operating for so many years and probably you record loss, you are going to pay minimum tax. If, for example, now the minimum tax for a company is 36 million, so we now compute their tax. When computing their tax, we now come across, or let's say we get their normal tax to be 30 million naira. No, we are not going to allow you to pay this 30 million naira. Rather, you are going to pay the minimum tax. Minimum is just like, least that you can pay. So that is that about that. So another thing you need to know is that in the computation of the minimum tax, the Finance Act rather has make it more simple. Like, it is simple compared to the one we have before. So what is the formula? The formula is simply gross income minus frank investment income, sorry. So your gross income minus your frank investment income, and it is just 0.5% of, so it's 0.5% of your gross income minus your frank investment income is what is going to give you your minimum tax. So that leads to the questions. Let's touch the components of each. Let me start with frank investment income. You see, frank investment income, whenever you're talking about frank investment income, let me give it in form of illustration so you get it very well. There are some companies that they also invest in other companies. Let's say company ABC now. Company ABC decided to buy shares from EDF. Yes, so company ABC decided to buy shares from EDF. So you will agree with me that company EDF is going to pay company ABC dividends, right? So, and I want you to know that dividend is also subject to tax. So when let's say company EDF wants to pay company ABC a 10,000 naira dividend. I'm playing illustration so that you can understand what we mean by frank investment income. Now, company ADF wants to pay company ABC dividend of 10,000 naira. This dividend of 10,000 naira, before company EDF can pay company ABC, company EDF has to remove tax. So let's say company EDF remove 1,000 naira tax. So instead of paying 10,000 naira, this 10,000 naira is the gross dividend. Gross dividend. Yes, so that means that it has not been subject to tax. But company EDF cannot pay 10,000 naira, it has to remove tax. So let's say it's paying 9,000 naira to company ABC. So this 9,000 naira is a frank investment income. And what are frank investment income? Income that has been subjected to tax. We call them frank investment income. You know, it is not possible for you to tax a particular thing or a particular income two times. So frank investment income are income that has already attract tax from other places. So it's not possible for them to still tax them again. Because what we are doing here is we want to tax our gross income. So we have to subtract frank investment income, which are income or investments that have been subjected to tax. And majorly under this computation, we do have dividends under it. So the law states that 0.5% of gross income. So I hope you understand what frank investment income is. That there are income that has been subjected to tax before. Sometimes organization might receive income that from where the incomes are coming from, they have been subjected to tax. And you will be notified in the question. So what you just have to do is just to take it away from your gross income. So talking about gross income, I feel a lot of us are familiar with this gross income, but I'm still going to explain it. When we talk about gross income, is income before the deduction of any expenses. Yes, that's what we mean by what? Gross income. Income before the deduction of any expenses. So what we want to do is that we want to accumulate the gross income of the company, maybe the gross income from their investments that is not subjected to tax, maybe the gross income from their rent, gross income from their trading activities, gross income from their businesses. So we now accumulate those gross income, we subtract it from the frank investment income, that means income that is subjected to tax, and we now tax them, which is 0.5. But there's something I quickly need to mention before we proceed, and what is that? Is that according to the same Finance Act, there's an exception or there's a stimulation. Let me put it that way, and I'm going to explain it. And I've seen questions whereby they test students on that particular, notes, but students don't take notes. But I'll explain it in this video. According to the 2021 Finance Act, it also states that any company that is remitting their minimum tax from the period of January 1, 2019 to December 31st, 2021. So anytime you are dealing with a question that falls within these dates, I mean that January 1, 2019 to December 31st, 2021, the formula you are going to use in computing your minimum tax will not be 0.5% anymore, but it will be 0.25% of gross income minus frank investment income. So that is the only difference in it, is that if you happen to have a question that is between January 1, 2019 to December 31st, 2021, the formula you are going to use in computing your minimum tax, you are not going to use the 0.5% anymore, but you are going to use 0.25. And 0.25 is like half of 0.5. So I don't know the reason why they stipulate or why they decided to want it this way, but for the reason best known to them, we just have to just stick by what the Finance Act has stated. So most questions, virtually all the questions I've been saying on minimum tax, their date always fall within this. Meanwhile, the normal minimum tax rate should be 0.5%. So if the year does not fall between this, it is 0.5%. So but the law has stated something else, and a particular thing we need to note. So let's take a question. So welcome back. So before I continue, there's something I want you guys to know, and I want you guys to note it. And what is that? Is that from the formula I gave us earlier, the gross income minus your frank investment income. The gross income, the frank investment income is part of the gross income, but you have to subtract it in the end. Yes, we say gross gross investment, gross income rather, minus frank investment income, right? Now this gross income, frank investment income is also part of it. But what you will do, you subtract it. But don't worry, I'm going to use the two methods so that you get what I'm trying to say very, very, very well. So let's go with the question we have here. We have a question. This question was gotten from Ican Study Pack 2024. Yes, 2024 September diet, ATS 3. So let's go. We have Josie Nigeria Limited is into manufacturing of paints and has been in the business for many years. An extract of the profit or loss account of the company for the year ended 31st December 2021 revealed the following. So we have revenue or turnover from main business 35 million. So we have the activities, revenue from suspended operations 5,500,000. Expenses on suspended operations 3 million. Profit from suspended operation, yes, we have 2.5 million. Rent received, we have it to be gross 850,000. Dividend received from supermarkets net. Dividend received from supermarket net 2,400,000. Revenue from other operating businesses 11,500,000. Expenses on other operating businesses 9 million. So profit from other operating businesses 2,500,000. So we are required to calculate the minimum tax. So note that anywhere you are seeing gross, it means that tax has not been applied, and you are going to add it to your gross income rather. But anywhere you are seeing net, it means that tax has been applied. So let's go. We have Juicy Nigeria Limited. We have Juicy Nigeria Limited. I'm going to use two methods, for us so that we can get it. Juicy Nigeria Limited. And the two method is, the first one, I'm going to add all my gross investment income. And the second one, I'm going to add all my gross investment income. Gross income or gross investment income, anyone. I will use different methods so that you guys will get it better. So let's go. First thing we have there, we have revenue from main business. Revenue from main business is 35 million naira. So let's divide the board like this. So we have this side, this side. So we have revenue. Revenue from main business, which is 35 million. 35 million. So I also come here, revenue 35 million. So we have revenue 35 million. We have revenue from suspended operation. Now, if you look at this very well, revenue from suspended operation is 5,500,000, and we have expenses on suspended operation. And don't forget that I told you that what we are computing is gross income, and when computing gross income, you are not is your income before you subtract your expenses. So when computing gross income, please don't take note of your expenses. Your expenses is irrelevant. All you need is the accumulation of the total income we made. Leave your expenses alone. So if you look at this, revenue from suspended operation is 5,500,000. Expenses on suspended operation 3 million. So the 3 million was subtracted from 5,500,000 to get your 2,500,000. But you don't need the profit, you don't need the expenses. What you need is the revenue, because you are dealing with revenue before subtracting all expenses. And that is why it is called gross income. So the revenue from suspended operation, revenue from suspended operation, please bear with me. Revenue from suspended operation, which is how much? 2,500,000. 2,500,000. No, sorry, 5,500,000. 5,500,000. 5 million. That's the revenue before subtracting our expenses. So we proceed. We have rent received gross. Rent received is 850,000, and if you can see gross, it means it has not been applied to tax. Tax has not been deducted. So what do? We add it because tax has not been deducted. So we have rent received. rent received, rent received, how much, which is 850,000, 850,000. So I come here also, rent received, 850,000. So now after that, we have dividend received from supermarket limited net. So that net means that this dividend has been subjected to tax. So we don't have to tax it twice. So there are two methods we can go about this. The first method is that we add it to our gross income because it's part of our income. We add it to our gross income, then we later subtract it. The second one is that we don't add it at all, so we don't need to subtract it. So I'll do the first one here, I'll do the second one here. So we have our dividend received. You can use any of the two in your exam, but majorly the one they do use is the one that you will add it and you will later subtract it. But anyone you use, you'll be marked right. So we have the dividend received from supermarket net, which is 2,400,000. So we have dividend received, which is 2,400,000. So 2,400,000, and we have revenue from other operating business, 11,500,000. Expenses on other operating business, 9 million. So we don't need the expenses. All we need is the revenue, which is how much? 11,500,000. So revenue from operating business. Revenue from operating business, which is how much? 11,500,000. 11,500,000. Revenue from operating business, 11,500,000. So what do we do now? We add everything together. So if you sum it up, for this we'll be having 55,250. The one we added, don't forget that here we added our dividend received, which has been subjected to tax. So for here we did not add it. So because here we have already added, what we will do, we subtract it. So if you subtract it, you will still be getting the same value with this. Let's go. So what do? We come here and we subtract our franked investment income. So we say franked less franked investment income, which is our dividend received, and our dividend received that we have added before, we subtract it, which is 2,400,000. And if you subtract it, you'll be having 52,850,000. 52,850,000. So which is the same thing we have. So as you can see, any method you use, you will get the same thing. So, but the most popular one is this one, where you had your frank investment income, then you later subtract it. So whether you use this or this, you'll be marked right by the regulator. So the next thing we need to do now is to apply our rates. So don't forget that I told you that if it is 0.5%, if it does not fall between January 1, 2019 to December 31st, 2021. So let's look at this question. Does it fall between those dates? So we know the rate to apply. Let's go back to the beginning. They said JC Nigeria Limited is into manufacturing of paints and has been in business for many years. An extract of the profit or loss account of the company for the year ended December 31st, 2021. December 31st, 2021. And the date I said earlier was January 1st, 2019 to December 31st, 2021. So you can see that it falls between that dates. So what rate are we going to apply? Of course, it is 0.25, because if it falls between this range, between these dates, we should apply 0.25 as our rate. So we apply 0.25 on this, so we know what we are going to get. So if you apply 0.25, so 0.25 of this 0.25% times this, so it give us 132,125 as our tax. So 0.25% of this, it will give us our minimum tax. This is our minimum tax. So our minimum tax will be 132,125. This is our minimum tax. So we've come to the end of our first video on minimum tax. In our next class, expect more videos on company income tax. Expect videos like computation of CIT using the from the dividend, from the gross turnover, why sometimes we compute CIT from the gross turnover and sometimes from the dividend paid and so on. So, but one thing we just forgot to include in this class is that we did not put the year of assessment, which is very, very important. And the year of assessment for this one, since it falls in 2021, then the year of assessment will be 2022 year of assessment. I believe this one should not be a problem if you understand basis period. Yes, let me just give a random short explanation. The reason is very simple, is that tax of 2021 cannot be collected in 2021. Rather, it will be collected in 2022. Yes, because if you are preparing your accounts in 2021, tax authority might come when you are not done preparing your account. So what they have to do, they have to wait till the next year before they can collect the previous year tax so that you can close your account. So since it is 2021, this tax will be collected in 2022, but we use 2021 tax, tax law of 0.25 is what we use on it. So if there's anything you do not understand, please take it back, watch it, and make sure you understand it. Until I see you again in our next video class, till then, give the video a thumbs up, share it with your friends, and so many more, so that we can both grow together.